This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cashback on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 48. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management, everyone's favorite boomer, and we've got Rich Diaz of Acorn Macro Consulting, no longer in Canada, now back home in the UK. I don't know if this is, and I'm in Italy here, so I don't know if this is no longer a Canadian podcast. We will strictly be talking about the Eurozone moving forward. But how are things? What's going on, Rich? You're settled in there or what?
Slowly, back into my flat.
Rich booted his tenants out, by the way. Slumlord.
No. Credit. I know that they do not listen to this, but I will give them mad props. They left the flat in immaculate condition, so I'll just give them lots of credit that they'll never hear. No, back to London. Took the tube yesterday. It was great. No longer have a car, which is fantastic. I'm not sure I'm a driver, but yeah, it's been sunny. Alcohol is super cheap in the UK, ladies and gentlemen, and so that's been nice. We'll see how the next year goes with the new prime minister and energy prices and all other kinds of things we're going to dive into today. But yeah, so far so good. Back in the whole flat.
I'm happy for you, man. I know you've been looking forward to the move, and Keith is apparently throwing a raging. You got a barbecue there today?
No.
Okay.
Go on.
That's the end of the show.
No, we're done. No, tonight, this is Thursday, of course, we're doing this. So
Bingo
tonight at the Beer Garden here in Halifax. We have a few people getting together, so it'll be fun. Be a good night.
And like now, though, home address.
Yeah, absolutely. What's great though, here we are, like the three corners of the world. Rome, London, and Halifax.
I'm here, boots on the ground to report live on the energy crisis.
Yeah, are people like burning up their statements of their bills? Have you seen any of that? Have you heard?
No,
about that,
what's interesting. I'm such a weird person. Like I we're all kind of weird here on this podcast, but it's just like that scene from The Big Short where Steve Carell's like, he's like looking around. He's like, look at these people. They have no idea. Yeah. And that's kind of like how I feel. I was like, look at these people. Like they're so happy. Like, don't they know? Like they're going to freeze this winter. No, but in all seriousness, the energy crisis is heating up. We have a lot to chat about in this week's podcast, all jokes aside. We had a huge movement from the BOC, Bank of Canada, obviously, which we'll get into, rate hikes from Australia, rate hikes in the Eurozone, energy crisis unfolding, government, controls of energy pricing and various, whatnot. So we'll kind of get into this week's show, but I think we should start things off this week with the Bank of Canada. We did a Twinkie bet last week. It was in fact 75 basis points from Tiff Macklem. I don't believe there was a press conference, correct me if I'm wrong, but there was no additional real commentary following it. But basically Tiff Macklem or the BOC's commentary very brief as it was basically, I think it was just in written word, was that more was to come. And I don't know what
There's going to be a Twitter Spaces. There's going to be a Twitter Spaces.
Yeah, it's going to get sloppy here. But anyways, the BOC now is at, I don't even know what they're at now. I'm just losing track. They're at 3.25%. So they've raised rates a full 300 basis points. Of course, we're starting to see people's mortgages get triggered. Keith, I don't know if you have any initial commentary on that, but you also owe us a Twinkie. So feel free at your leisure to devour that thing.
I love the Twinkies. I think, what's really funny about this show is that, we're all right and wrong with these bets. So you guys have to try to scurry out there and try to find a Twinkie. And, but for our house, I just go to the cupboard. They're always there. So it's fun. So
this is Ice Cap's a great lady.
Yeah. Where's Charles this week? Who knows? But, this week, so Bank of Canada, so there was no presser this week. They just came out. It was in line with expectations. So even though the currency did nothing on the announcement, and it did strengthen later on in the day, but that's because the dollar just got weaker. So everything just strengthened. It wasn't a Canadian dollar event. So probably the two key things that happened with this rate increase. One, in the announcement, it is sort of suggested that the rate hikes are going to stop very soon. Like we're almost over. And then if you look at financial markets, they're also suggesting the same thing. So right now, the next meeting is October 26th. And we're pricing in about 50 basis points for then. And guess what happens after?
Hockey season?
No.
Oh.
Steve.
I have no idea. The housing market.
No
rebounds. Bull market. I get paid.
There she was, gone. All their rate hikes are scheduled. Well, they're priced in to stop after October. So if you go from October right out to next July, the markets are not pricing in any more hikes.
October to July, just like hockey season.
Yeah. Maybe that's it.
Maybe that's how Tiff Macklin sorts out his interest rate policy. He's like, well, okay, boys.
Yeah, we'll see. I mean, I didn't see the Bank of Canada on Twitter this week. Rich, what are your thoughts on the Bank of Canada and their Twitter policy?
Well, I owe you guys a Twinkie as well. I thought it was going to be 50.
Guys, I need to interrupt for a second. I got 2 hours to go do something. So when I come back, you'll be finished on your Bank of Canada.
No comments on the Twitter sphere. Sorry, Keith. I didn't mean to entertain all of our lovely listeners. I don't have any terrible jokes either. But no, got nothing else to say on the Canada thing. Nothing more than I still don't think that raising rates, as we've discussed many times, was going to affect the the inflation outlook. I'm still keen to keep an eye on the 2 or 3 items that we've discussed. And, I think in a couple of weeks, we'll have the inflation print again. One is the shelter component, which is obviously going to probably take a hit from housing. And then the services component, which, has been grinding higher. And I don't necessarily see how interest rates of 1, 2, or 3 are going to affect that part of sort of the inflation basket. As far as my payoff, I looked high and low for Twinkies. They don't sell Twinkies in London.
Count.
I found. So I found the worst thing. I found an even worse food stuff, which will just have to stand in, which is peppermint stuffed chocolate thingies. And I could not think of anything worse in life than putting mint and chocolate together. And
those those sound delicious. My wife, those are like big on my wife's. That's like a premier chocolate.
It's like mint ooze that's been injected into chocolate. I could not think of anything worse to put in your mouth.
Fire that thing in the mail. I'll eat it for you.
They already have those. What's the little box of them? It's a white box with a little brown...
I got this too, but this is tea cakes. These are delicious.
Buddy, we're trying to get a sponsorship from Hostess Twinkies here.
Well, I'm going to eat one of these disgusting chocolate mint things.
And no, eat the other one. The other one looks...
Okay. All right, here we go.
Even more
Wait.
Interesting.
So to sum up, I don't have anything to add on the Canadian banking thing.
I do.
I do as well.
Boys.
I want to jump back in before...
Go for it. Wanna eat this
the
thing.
Roman lover there comes back in with his view on things.
Keith, what's the let's provide some actual value to our listeners here. What are the markets now pricing in? What are they pricing another 50 basis points by year end before rate cuts?
So 50 at the next meeting at the end of October. So that'll bring us to 375, and then that's it.
Okay. And then I mean, obviously markets aren't always right, but I think markets are pricing in rate cuts at some point in 2023, correct?
The market for that only goes out to July of next year. And again, this is a financial market product. It's not an economist making a forecast. Right. The market is showing no more rate hikes. And so what happens with central banks, once they stop hiking rates, they never hike again. The next move is going to be down. And with the Fed, because they have the best data, on average, it takes the U.S. Federal Reserve is usually about 8 months before they cut rates again. So using that, let's say the Canadians, they stop in October. We are looking at, maybe they cut by next summer. We'll go into this as well after I know you want to say something, Steve, about the banks, but guys, the financial markets are at a very serious moment right now. And I'm just going to be absolutely shocked that we get through to next summer without either a rate cut happening, or you could actually see the opposite in rate hikes. So remember back when the Asian currency crisis, was booming back there in the 90s. So back when you guys were in day school?
I was in high school.
You were in high school?
Yeah, grade 7, I think.
Grade 7. And the last kid to be picked for dodgeball again, Rich Diaz. But back then, as soon as you get into a crisis on the currency side, you had to raise rates to protect it. So, I was listening to the ECB presser today, and one of the questions to them was, what is the normal rate for these guys? Where do you expect them to go? And I'm screaming at the computer myself. I'm thinking 15, 20%, something like that, because I think that's where they'll have to go. But they're not
going to raise rates to 15%. Anyway, carry on.
Yeah, just thinking I have to be considerate now because I have the 2 Europhiles here on the podcast with me.
Okay.
Yeah. To get it?
I mean, keep going.
I'm done. That's it. What do you have, Steve?
Well, no, I mean, I think that it's funny. I was getting ragdolled on Twitter. Somebody pulled up like a tweet from October 2021 where I think I said like the BOC would get rates to, like 1.5% or something, and they'd probably cop out. And everyone's like, oh, this, the wrong predictions. Guys, like nobody. I mean, maybe some of the odd tinfoil hat guys, like, that pop up on YouTube occasionally, like nobody had the BOC getting rates to 3% 12 months ago. Okay. Even Scotiabank at the beginning of the year, I think they had 8 rate hikes. Okay. So I think it's just important to understand that, like, the most important thing that we talk about this show, like, yeah, we're obviously trying to like bring valuable information. We're trying to bring at least a little bit of insights and from our own industries and whatnot. But at the end of the day, it's like, when the data changes, you have to change, right? I mean, I don't think like any of us, expected inflation. We've all been very pro-inflationary on this channel, I think, from the get-go when it was deemed transitory. And I don't think a lot of people really expected this thing to really drag on. And obviously the energy crisis to continue to manifold. Like, now like, Russia's talking about shutting down, the entire gas pipeline there into the Eurozone, right? I mean, like these things continue to evolve. And so I think we just, at the end of the day, it's like you can use your best judgment 2, 3, 4 months out, but as the data changes, your opinion should change. And so, yeah, the Bank of Canada right now is at 3.25%. I think this is bringing definitely a lot of pain, and people say, well, nothing's broken yet. Everything's fine. You said it was, you said stuff was going to break. Guys, we're 6 months into a rate hiking cycle. The 60-40 balanced portfolio, which is what, Keith, as you would know, like the vast majority of your traditional portfolio managers are using, your 60-40. I mean, it's year to date, it's down 14%. I mean, it's the worst return since we've got data going back to the 1970s. And this is people's retirement funds here that are being impacted, right? So I mean, the pain is here, and asking one in Europe, the pain is coming, and it's already here for a lot of them in terms of what's happening, not only with their energy bills, but now with interest rates as well. So just a quick note on that with the BOC. I think that people continue. The biggest thing that I've observed, Keith, Rich, I don't know if you guys want to chime in on this, is I think there's a genuine lack of understanding, only because I'm not going to say that I'm an expert on this, but I've done a lot of reading, and I'm genuinely fascinated about like private debt. And I think that the vast majority of market pundits or experts that are pontificating on rates and how high they can go, I think ignore the role of private debt and just how levered the private sector is, particularly in Canada, to assume that this is just going to be, a housing only related event. And, you can just have a national house price correction of 20, 30%. And we can just continue on with our merry ways. And there's no like spillover. The one thing that I would like to bring up is David Rosenberg. Again, hey, he's been wrong. But he brings out, it's funny. I'm actually looking at his tweet right now. He just deleted it. He got the info wrong. But on a $7 trillion economy, the increase amounts to $200 billion increase in debt servicing costs. So on a $7 trillion economy. So anyways, suffice to say, I think this is going to continue to bite. Housing data remains weak, despite all the real estate pundits and realtors talking about, hey, this is the end of the last rate hike. The housing market's bottomed. I don't think it's bottomed. I think that activity is going to moderate a little bit, but I think that there's still downwards pressure. Rates are simply too high. So with the rates moving up 75 basis points, your variable rate now went up 75 basis points. So anyone that was escaping these fixed rate mortgages and saying, hey, my fixed rate was 5%, but I was able to get variables at 4.2. Your basically your variable rate is now essentially the same as your fixed rate, which means if you're going to qualify for a new mortgage today, you pretty much are getting stress tested at 7%. So your borrowing power went down after this rate hike. Your borrowing power, you just lost another 8% of purchasing power. And so, if you can borrow 8% less dollars, I mean, that typically starts to reflect in your house purchase prices. So I still think there's more downwards pressure, which I ultimately think is deflationary if you give it enough time. So that's all I have to say.
Oh, my turn. I think you're right, by the way, as far as not having felt any of the negative effects in Canada are concerned. But before we get to that, I think what's important to remember is interest rates are still negative in real terms. And now there are different ways to calculate this, of course. And I bring this up because I think when interest rates become positive at these much higher debt levels for households, that's when we're really, really going to start to feel the pain. And make no mistake, it will happen eventually. But real interest rates are still negative. How do I calculate that? I mean, there's several different ways. We've been mercifully helped along by some of our listeners with using market priced measures. I like to use sort of lagging indicators for this kind of thing, just because I think it gives you sort of a feel for much more a sort of a macro sort of top down view of it. And if you look at global or OECD headline inflation, it's at 10.2%. And global government bonds, depending on your duration, let's just pick a duration of, let's say, 2 or 3 years, to reflect a lot of the debt burden that households might take, especially with mortgages. I know mortgages are more short-term in Europe, Canada, and the UK than they are in the US. US is a 30-year fixed rate. And if you look at that global bond yield, it's 4%. So you add a bit of a spread to get to, let's say, 5 or 6, and you're still negative by 4%. And I think that negative real interest rate is what's sort of saving people right now. And for me, that's really what I'm watching. And then as far as your question on whether or not corporates can survive these kinds of inflation numbers, I think it really, really depends. And sorry, debt numbers. I think it really depends on where they're feeling the pinch. We're going to talk about energy in a little bit. The energy, I think that's an acute, enormous amount of pain that companies basically cannot survive. I mean, I've seen numbers from mom and pop, mom and pop farmers have bills of they will have bills of literally hundreds of thousands of dollars over the winter and they forecasted out what their projected energy bill might be. I mean, that's just not going to happen. The governments won't let, thousands and thousands of companies go bankrupt. But as
We
far
did
as
touch on that, by the way, that's
Yeah.
a big.
I know.
That's our
But
next
anyway,
point. But continue.
But I was going to say that as far as like whether or not corporates can survive with interest rates higher and higher, I think a lot of, so two things. One, a lot of in the US, I think it's a much different scenario than it is in Canada. In the US, you saw mortgage applications spike when interest rates were very, very, very low, and mortgage applications, which is an index of mortgage, of people taking on mortgages and buying homes, is very, very low right now. And so people are just not transacting in the same way in America as they are in Canada. In Canada, it's different. In Canada, you take on 3, 4, 5 years fixed rates. You have a debt to GDP that's 110 versus 70. You have a reset, whether it's that lock-in clause that you've discussed, or just literally the end of your 5-year reset, 5-year fixed mortgage period, that we're about to come right to that number, whether it's this year or maybe in next year. And so you've got an incredible amount of people that bought homes in 19, 20, 21, that over the next, let's say 12 to 24 months, are all going to just naturally redo their fixed borrowing costs, their fixed mortgage costs. And I mean, so we're just about, in my view, about to feel the macro side of all of these interest rate hikes. We have yet to feel them, in my view. And it'll be interesting to see how the market starts to price that in, right? Because the market is usually, a discounter of what's going to happen in the macro space, right? Usually tends to happen a lot quicker, a lot faster in the markets. I don't know, Keith, I don't know if you have anything to add on that, but I just think we have yet to really feel these interest rate hikes is the way I would describe it.
Yeah, that's in line with our thinking. So we continue to expect that the world and Canada as well, we're going to see an economic slowdown coming up. That has not changed. We continue to see increasingly more evidence to suggest that it could be a pretty hard landing. And so that's especially true in Europe. And I think that's now creeping over. We need to talk about this energy crisis. And we're now starting to see policy responses from governments. So we'll go into that as well. But just setting the stage here, because, Rich made some good points in that, just because of time, we are approaching this moment where a lot of households are going to start to have to take more of their discretionary income and allocate it to debt payments. Governments will be doing the exact same thing.
Good point.
Yeah, the governments will be doing it. Usually companies are really good at controlling their debt and their interest burden relative to governments and households. But one thing I want to touch on, because everything is linked together. Like you don't view, Italy on its own, Britain on its own, in Canada and stuff like that. But in the currency world, we're now at this point where sterling, yen, and euro, they're all back to levels that were first reached back in the 80s, like 85, 86, and 87. And it's just astonishing. Like there's something clearly wrong in this system. And again, these are not emerging market economies and countries and central banks. These are like the 3 big ones in the world. And these currencies are really struggling. Because remember last week, I think I quizzed you guys, say, hey, which central bank is dovish? And everyone else was bullish, or sorry, hawkish. And then Rich said, oh, that's easy. It's always the Bank of Japan. And, the yen this week, 2 days ago, had a 2% down day. That's like the NASDAQ being down 15% in the morning at the open. And then the next day, and usually you get a bounce, it was down another 1%. And so when yen is down that much, it totally ticks off the Chinese. And all of a sudden, then the Koreans are upset, all the other smaller economies in Asia. It's like, wow, we all have to devalue here. Because that's what the Bank of Japan is doing right now, that they're implicitly devaluing their currency to save the bond market.
It's the start of a currency war.
Have you guys read that book by Jim Rickards, by the way?
No. What's it called?
Currency Wars by Jim Rickards. I mean, you can love him or hate the guy, but apparently that's mandatory reading at Bridgewater. Ray Dalio, Currency Wars. Good book.
Yeah, and that stuff works during a normal market cycle or economic cycle. But again, I mean, you know our view with that. We are at the end of this long-term 75-year secular movement, with Rich's second favorite t-shirt guy. Where's it 3? Because I like the one with you with
No,
the beer goggles. That
I
ranks
have,
up
I have a
there.
Milton. If you're asking,
Yeah.
I have Milton
How do
Friedman.
they
I have
rank?
Thomas Sowell. I have Keynes, and I've got Esther Duflo, who is one of the few women who've ever won an MIT. Sorry, from MIT, who've won a Nobel Prize in economics. You're welcome to check them out on
And
my
you have a
website.
shirt. You have a shirt with your own mug on it. I think we
Yeah.
got to have like a T-shirt sale the next event on December the 1st in Toronto. Plug.
Yeah. Plug.
It's funny because like I have mine at Steve Saretsky, Rich Diaz, Brent Johnson. You go down like that.
It's a good order.
Yeah, I know. It's
But Keith, oh, sorry, go ahead.
yeah. Well, my point is that we because Steve made a really good point earlier. We're talking about how many rate hikes will the central banks do, and it's always very difficult to pinpoint these things. They don't know which direction they're going in either, really. But we keep coming back to the same thing. Something is going to break here in this system, and when you get these 3 major currencies all just screaming lower. And remember, it's not a zero-sum game. Somebody else out there is really feeling the heat on this right now, specifically in Asia, and it's specifically China. I can guarantee you that. We are at the moment where you're going to start to see the RMB. It's getting loosened every single day, and then that filters down then to Hong Kong as well. I always laugh on Twitter. They have this like stupid argument going around in a circle about the Chinese are selling their treasuries so they can buy oil and have it settled in, the ruble yuan and stuff. It's garbage, guys. It's complete fantasy if you ever go down to that rabbit hole. The Chinese are starving for dollars right now because they get dollars coming in when the world economy is just booming, and it was booming for 20 plus years. So they got admitted into the WTO. And then all the Chinese companies got listed on the MSCI indices and stuff like that. And that game is now over. Like globalization is over. Now all of a sudden the Chinese, they need dollars. They need US dollars, right?
Globalization is not over. Carry on. You're right about China, but globalization is not over. Keep going.
Globalization isn't over? I think it is.
Global exports as a percentage of GDP is going to go up over the next 10 years, not down. But anyways, keep going.
So Rich is now, he's been, what's the correct word I'm looking for? Anyway, Rich is now smack dab almost up against the border of the economic fantasy land called Europe.
I'm not going to let you make sweeping comments without some pushback. People will trade, countries will trade amongst one another for the next.
Okay, I think the point is
okay, guys.
Countries will continue to trade, but there is a friction point amongst.
Yes, thank you, Steve.
Yeah, as an example, guys. So as an example, right now the Americans, they're now going to penalize. I don't know the exact story here, but they're starting to penalize U.S. companies that are building chips with Chinese components. It was something like that. That was in the news.
Saw that. Yeah.
Yeah. So again, like this is happening. But back to the sort of
basically, sorry, the U.S. government's been subsidizing some chip manufacturers, and they're saying if you are setting up new shops in China, we're pulling the plug on you, basically.
Yeah, it's happening. So, we are at this moment where we have all this stress taking place, and a lot of it is the energy crisis. So we sort of need how to jump over, because there are bailouts happening right now. So I know, Steve, you've been covering a few of them. So we get the bailouts in Europe and UK and even in Canada.
And for my own household.
You're going to have to explain that.
Yeah, getting my trigger rate. No, I did get, I would have been trigger rated, but I actually increased my payments like a month ago. So, anyways, take that for what you will. I think that's a big story. I know RBC talked about 80,000. So, anyways, lots happening behind the scenes. But continue, Keith.
Well, I think we should talk about how I don't know if people are aware or not, but governments are now moved to the stage of bailing out companies as well as households for energy prices going up. So in Europe, if you guys want to take it, you can. But in Europe right now, a lot of corporate entities, they're now it would be basically debt bailouts from governments, especially in Germany. And Germany, as people might know right now, so the Russians have turned off the As the White House press secretary called it, the Nord Stream 1 gas pipeline. So Rich seems to like that one. It's not Nordstrom. It's
Is that another
Nord
boomer
Stream.
joke? That one missed
Nordstream.
too.
That was a Nordstrom is a shopping mall, right? It's like the Bay or a Zeller,
Yeah,
isn't it?
absolutely.
Yeah,
Yeah,
okay.
The White House secretary called it Nordstrom. And I was
Keith
like,
is
oh,
more of a
man.
Sears guy, I think.
Yeah. Wait, can I? But I think
Well,
Keith,
wait,
if I may. All
No,
right.
no. We're getting the Keith's fashion trends. I was a Kmart boy as well as Woolworths as well.
Ooh.
Just to
Both
be
out
clear.
both out of business.
The
Sounds like
Zellers is
Rain
making
Man.
a comeback. Zellers is
Like,
making a comeback.
What do you got, Rich? What do you got?
Well, I was just going to say that the thing that I think you left out, although if I may, is that the yen, ECB, and obviously the pound, the yen, euro, and pound, they're getting smoked because of the energy issue. And just to give some context, maybe some numbers, the reason is because let's start with the European Union. The European Union consumes about 10 million barrels of oil per day. Remember, everybody, a barrel of oil is 42 gallons. Don't ask me how many liters that is. And they produce virtually nothing because in their infinite wisdom, they, have, for one reason or another, have basically refused any kind of exploration. And they have hooked their RV to the oil tanker that is Russia. And as a function of Russia's aggression in the Ukraine, they're in obviously a pickle. Japan also consumes about 4 million barrels of oil a day and produces zero. That's a function of geography. There are no known oil reserves off the coast of Japan or in the Yellow Sea or in the Sea of Japan. And obviously they import all of their energy as a function of them turning off their nuclear power plants. We're seeing we're going to see a very quick U-turn on their nuclear power plant policy. If I'm not mistaken, I think they've already okayed a bunch of them. Anyway, so that for sure is going to happen. So and then the UK, which used to produce a lot of oil in the North Sea, it consumes about maybe just over between 1 and 2 million barrels of oil a day. They produce a little bit, but their net production is negative. And so again, they import an incredible amount of natural gas for heating and energy. They have spent a lot of money and time on the renewables, which we know are not fit for purpose or is being exposed as not being fit for purpose. And the UK is, as a function of that, going to green light two things over the next couple months. One of them I'm sure about, one of them I'm not quite sure about. One is they're going to green light nuclear power plants all over the country. I think that's a very, very clear sea change. And then the other thing is, I think that they just under the new prime minister, they're going to green light some oil and gas exploration. Again, it's not because they don't know it's there. It's just because they haven't been spending the money,
you move there and things start changing.
Maybe
it's like they're listening to the
right.
pod.
That's right. They listen to the
just
pod.
got a new job.
So I think it's the reason we're having, yes, there's lots of problems with Europe. Yes, there's too much debt in Japan. Yes, there's maybe productivity problems in Britain. But I think, in my view, what's happening right now is very, very specifically an oil and energy issue. I don't think if oil had spiked or natural gas prices weren't 10x what they were 2 or 3 years ago, you would having the yen, euro, and pound making 30 or 40-year lows. Now, would they be lower? Would they be weakened because, US has better productivity and it's just a better economy? Maybe. Okay, fine. But to see them at 30-year highs or lows, depending on which way you look at it, I think that's strictly a function of, the fact that they're not in a position to provide enough energy. And as we've discussed at length on this podcast, crude oil and energy is super important. And so that would be my only addition to Keith's, I think, extremely well put little soliloquy.
I think we should basically take that though and summarize it, which is okay, so you have all these issues. You've got, rising cost of living, Europe's on the brink of everybody freezing in their homes this winter. And, in Canada, for example, rates are going to go up so high that everyone's going to foreclose and lose their homes. And I think what we're now seeing is the reaction function of governments,
good
which
point.
is okay, goalposts start to move. And again, like this is not about right or wrong political leanings. This is just simply a factor of like goalposts are moving. So we see, for example, in the UK, which is from Javier Blade today, that the UK government is freezing gas and electricity bills for the average household at $2,500 for the year for the next 2 years. I don't know exactly, again, all the specifics of that, but apparently it's going to cost, I believe it's in the hundreds of billions does that sound right? 150 billion. They're estimating that to cost the UK government. In Canada, for example, Keith, you were tracking this, was the Trudeau government has now announced that they'll hike GST rebates that will help with rent payments as part of a new affordability plan. That's per the Globe and Mail just today as of this recording. We record on Thursdays, by the way. And then, for example, even for myself, as somebody that's in the housing market here, I look at what's happening in British Columbia. If you guys are familiar or tracking the BC housing market, every single year, as per BC government regulations, is a landlord is allowed to raise their rents by whatever inflation is for the prevailing year. So in 2023, I believe the average rate of inflation in British Columbia was like 6.5%. So that should have been the allowable rent increase for landlords. The BC government came out and said, no, it's 2%. We changed our mind. And this is actually part of their sort of plan to sort of basically fight, quote unquote, inflation. So again, the goalposts are moving, whether you agree with it or disagree with it. The idea that Europe's simply going to roll over and that everyone's going to freeze to death, and in Canada, everyone's going to foreclose on their homes. I think we just have to understand that this is the policy. Not to say there isn't going to be a lot of pain. There's still going to be a lot of pain. Businesses are going to close. People are going to suffer. There's going to be people that still lose their homes, but governments are going to intervene. Anything that is unsustainable for a long period of time eventually gets corrected. So, Keith, I don't know if you have any comments on that, but.
No, I mean, so I look now from a market perspective. And so one of the big allocations that we've been waiting to make is an allocation to the oil markets, not the stocks, the equities, but to the commodity. And I think we've been 5 months now waiting, and we've been targeting, like if you're looking at the West Texas Intermediate, it's WTI, where are we now this morning? 83, 84 bucks.
West Texas?
Yeah. Oh, no, that's gold. Sorry.
West Texas is 81. Is 81. And Brent is 88. Sorry.
Yeah. I'm looking at the futures market. Rich is living in the spot world.
He's got his fancy.
Isn't that a funny?
Here.
That's a funny joke, right?
Is funny.
Hey, thanks, Rich.
Okay. Can't all afford Bloomberg.
That's right. Can't all afford Bloomberg Live.
But no one lives in the spot world. Jeez.
Okay, so 83 versus 89. It's up today. Anyways, keep going.
Here we go. Right, 83.58 for the near term. The point is. So this is what Steve was talking about. We get a lot of bad things lined up, it seems like, but there are some self-correcting movements or mechanisms, because the global economy, it does self-correct itself. So oil has been coming down gradually, and of course, if you're depending on oil, that's helpful. If you're in Europe, then you're living in a different kind of land. But we are getting cheaper oil here. So from a pure investment perspective, we are starting to see the entry point coming up, for oil. And it's probably within the next, I'm going to say 9 to 12 weeks, we'll be there. And after we do it, I'm going to say, yeah, we actually did it 4 weeks earlier, because, we won't announce it in real time.
I know, rag on the listeners here, eh?
It is sneaky. But again, we always state that no matter how bad something might look in the world, there's always a way to make money on it. So if this is going down, something else is going up. And the other thing, like with people with their investment strategy, if you really like something, you want to do it, you don't just storm through the front door and buy it. You have to wait and be patient. So some of the best hedge funds out there as well as long only shops. You'll have the PM and the analyst and the trader. That's the way the role will work. So the analyst will come up with the idea, yeah, we want to buy this. It goes to the PM, they determine, okay, this is the allocation we want to make. And then the really good shops, when it goes to the trade desk, they're the ones that will decide when the execution will take place. And the really good shops might say, you know what, this might take months to get this in. And that's the point. So if you have a good idea, you think something's going to be great. If you're patient, you are going to get it. And I think that is coming up right now in a lot of these commodity markets, and same with equities as well. So, but I just sort of get the sense that over the last 2 or 3 days, people are starting to feel better about themselves because equities have they sort of bounced a little bit, and that's just sort of the sentiment I'm feeling.
You think? I don't know, man.
Are you feeling the same, or maybe I'm in a different world? I don't know.
Rich, I don't know what you think. I'm on Twitter like every day, and I think the sentiment is horrendous right now. Like,
well, I want to relate sort of the energy crisis and Keith's self-correcting point with the interest rate hikes we're seeing, and your point, Steve, that we're still, I think, in for it. And if you look at the 2-week rate of change for many of the commodities that I look at, I don't know if there's a commodity I don't look at, but you can look at natural gas, you look at jet fuel, you can look at gasoline, all this stuff. And if you look at basically the entire fossil fuel space, has had a 2-week decline of anywhere between 10, 15 in some cases. And natural gas prices in the UK are down 26%. And the reason I bring that up is because it relates to sort of Keith's point about the markets, and then Steve, your point about sort of the sentiment. And the reason we look at commodities, especially oil, is because it's often an indicator of expected growth or a sentiment indicator. It's a commodity that's linked to the global growth story. Sorry, I couldn't say that. And when you see especially fossil fuels, and of course, yes, metals to some degree, but oil is specific because it's fungible, it's global, it's not going anywhere. Sorry, Greta. Everyone in the world relies on it. It's traded every day all over the world. And so when you see these sell-offs, I'm just looking at it right now, crude oil WTI 2-week rate of change is down 14% as of yesterday, because I don't have Keith's fancy Bloomberg. And so, so to me, that's an indication of your point, Steve, which is, even though the market might be bouncing, I think that there's definitely growth. The sentiment on growth, I think, is worsening. And I think the crude oil and a lot of the other commodities sort of speak to that. Is that what you sort of were alluding to, Steve?
Yeah, absolutely. I mean, I think I'd love to also chat on the, see if you got that. And then, I don't know, just like, you got the ECB, Keith. I know you were following closely this week. They actually had some commentary out today. So we had the RBA, which is the Australian Central Bank, raising rates this week. And then also, we talked about the BOC, Bank of Canada, and of course, the ECB and the economic fantasy land, which Keith has followed so closely. Keith, I remember, again, not holding you to account, right? But I mean, at the beginning of the year, it was like, hey, these guys are never going to raise rates. I mean, they raised rates 75 basis points today, but there's a little bit more to that story, which I'd love for you to sort of chime in on it and sort of explain, your commentary on the ECB there.
Yeah, it's like they're trying to, go for a swim without getting wet, if that makes.
Oh, you're on a roll today, Keith.
Is that a good one? That's not
you're
bad.
On a roll. You were in a slump there for a couple of weeks, but now you're back.
I know. It just, it was the summer. But for, so what the ECB, they did raise rates today. It was 75 basis points. It was right in line what the market was expecting. So there was no movement at all in the currency market. So it sounds like, hey, they're now hawkish. We're going to raise rates. We're going to crush inflation. That's what they kept saying. And but at the same time, though, they're pumping out more liquidity to the commercial banks, and they're actually being more aggressive with QE in certain ways. They're doing it in funny ways. So on one hand, they're hawkish. On the other hand, they're still being dovish. So
isn't their balance sheet still growing right now?
Yeah, because they're reinvesting. But the main thing they did, I don't even know what the new acronym is. So maybe you guys remember the new. twist.
Oh God.
No,
Yeah, I
we
remember.
talked about it a couple of weeks ago, but I forget now.
Yeah, I mean, God, like even today, she was still talking about the Tilitro number 3 or 4. But the point is with Europe, guys, they're
It's the anti-fragmentation tool. Remember?
Yeah, that's it.
yeah, that's a good one.
There you go.
But they're raising rates to try to force inflation to come down, which is being caused by a lack of energy coming into the system. It has nothing to do with rates. So they're in for a real tough time here coming up soon. I mean, so some of the just one second though, but like some of the guys I know, they're really deep with the Fed and the Treasury. They think the dollar can go up maybe another 4 or 5% from here very quickly. So if
That's
you
a
want
lot. So it doesn't. Sorry, for people might not know at at home, but that's a lot when you've already moved 10 or 15 or whatever 20%. A, and then B, the dollar's the most important currency in the world. Sorry, Keith, I don't think people understand.
Yeah,
how
so we're looking at
5%
so right now on the DXY is around 110. So we're looking at maybe like a 115. So that means maybe it can go to 113 or 117. No, but a lot of the guys know they're saying, yeah, that's probably where it is. Now, if it just gradually gets there, up to Christmas or something, then that's not a big deal. Like that's not going to hurt anyone. If it happens, by week 2 of the NFL season, like it's gonna wipe out. So like, for example, euro will be down to like 95 cent area. If the Canadian dollar has the same correlation, you're looking at low 70s, something like that. And, poor old sterling, that's going to 0, of course. So good or bad for Rich.
Rich's condo. Pick it up.
You should buy a swap contract on your.
Oh, I'd love
condo.
To do that.
Yeah.
Sadly, I'm not that sophisticated. But I do want to just touch something on the EMF on the FX side, but the emerging markets, which is something we don't really talk about enough here. And there's definitely this lot of pain. If you look at the INR, which is the Indian rupiah, if you look at the Turkish lira is a joke. And then but two currencies that have stood out in how well they've done relative to the US dollar. The first one is Brazil. So Brazil is usually a currency basket case. It usually doesn't do so hot. But as we've discussed here many times before, Brazil is a major exporter of oil and commodities. And so it's had, the good fortune of selling its commodities for hard currency in the form of US dollar, and has been able, and is one of the reasons why it's actually been very, very, very stable. And that's, I would say, probably a surprise. And then the other one that I think is really fascinating is the Mexican peso. And that's been lock a step with the US dollar. And so again, partly as a function of energy, the Mexican economy produces a lot of oil. I can't exactly remember quite how much, but it's a lot. They produce a lot of oil, and they also produce a lot of, they're net exporter of oil. And their economy is linked to the US in many, many ways. Number one, obviously, from an energy standpoint. Number two, from a manufacturing standpoint. So you have companies that basically manufacture, let's say, a truck in Texas. Well, it might cross the border 2 or 3 times. Thank you, NAFTA. But the other thing that's really important to the Mexican economy is they get an incredible chunk of their current account balance is a function of remittances. So there's a couple of countries in the world whose expatriates are so numerous and so productive and frankly wealthy, and make a consistent and concerted effort to send money back to their economy. So I think Philippines is one of them. I know Mexico is another one. I forget. There's a third one that always stands out, but I forget. But Mexico's current account balance is basically propped up as a function of all of the expatriates that send cash back to Mexico. That's just part of it, of course. It's mostly oil, mostly commodities. But the Mexican peso hasn't seen any of the negatives as we've seen in other countries. And I think that's important that when we talk about the US dollar space, that not all countries are suffering that fate.
Yeah, so that's a really good point. So when you strip out, because you put Canada in that same sphere, I mean that's where it is,
right?
If you look at, say, the Asian currency index, is a Bloomberg one for it, like that's down about 10% this year. And on a cross rate basis, let's look at JPY here for the same, get the year to date with my fancy machine. Hey, Steve.
With that thing to use.
Yeah. So, I mean, the Asian basket is down 10% and, like yen is down 20%. So even though you're down 10% relative to the dollar, you're up 10% relative to yen. And that's what I was alluding to earlier here when we started the podcast today. Some markets and economies are being held up because they have very positive trade features about them. And so that, so the risk here is that, there is a recovery and everyone will sell CAD, peso, and real, because that's the way markets work, right? You sell high, you're going to go buy these low guys and they'll spring up. Like yen could just, surge, skyrocket. Or the other concern is that like something breaks in the market. And all of a sudden, maybe peso in Brazil and even CAD for that matter, it comes off a bit relative to the dollar. But make no mistake, if you're in the currency world right now, you really have to focus on Asia and specifically the Chinese, because boy, oh boy, if those guys devalue more aggressively, that would really set some of the wheels moving.
There's another country in Asia we don't really ever talk about, but is extremely important, partly because it's a bellwether, partly because it's so integrated into the global economy, globalization, and partly because it produces all kinds of really, really useful stuff, phones, semiconductors, cars. They're one of the largest refineries in Asia, and that's South Korea. And just like we've seen a collapse in the trade balance of Italy as a direct function of the increase in energy prices, the exact same things happened in South Korea, which I think is wild. South Korea is an exporting powerhouse. If you want to look at what's going to happen in earnings, you just track the movement of South Korean exports, and it'll tell you everything you need to know about global earnings. And South Korea's trade balance, which has basically been positive since the aforementioned Asia crisis, which is in 1997, is finally gone negative, basically. And the only other time it happened was in 2008, and that was basically for a cup of coffee, and they went right back up to positive. And now it's massively, massively negative. And it's, again, a function of energy. They don't really produce any of their own energy. They import it all. And it's just, so this is just, it's not, we make a lot of fun about Europe and their stupid energy policy and how it's going to affect currencies and the lifestyle and how people live there. And the same thing's happening in South Korea. And I imagine to some degree, we don't see it because the data is murky out of China, but they can't be happy about what's going on in the energy prices either.
Oh, absolutely. And like for everyone, so the Korean won is down 15% year to date.
Yeah.
I mean, that's a pretty tough move. Anyway, so we have all that. A little bit non-investment related. Are we getting towards like the cool part of the podcast this week?
Oh boy.
Yeah, no, I'm just listening to you guys sort of spiel about local currency. I mean, my sort of only commentary, just to wrap that up, was just going back to all these like rate hikes and seeing what the ECB is doing. Like, you can't tell me like, what I mean? Because like the ECB is like, okay, we're gonna like hike rates to get inflation down. Like, you can't tell me it's a demand side problem in Europe. Like, you can't tell me there's this demand pull inflation in the Eurozone.
It's not.
The consumer is so strong and wages are just, this is the 1970s all over again. That it's, and I think you probably extrapolate the same thing to like here in Canada. Like, I just don't think there's this huge demand pull, but maybe I'm wrong.
I was going to say also, and the consumer confidence, and the other thing, I mean, not just the wages. I mean, consumer confidence is weak. Housing is finally rolling over in Germany. I mean, sentiment is disaster all over the German industrial space. I mean, what they actually need now is probably more liquidity and lower wages, not the opposite. Right. Sorry, Keith.
Exactly. You can't tell me like again, that demand is so strong, the economy is booming, that like, oh my gosh, inflation's out of control, we need to like wind this thing down and hike rates. It's like, no, you guys have supply side issues of horrendous policy, and I would argue a lot of that's the same in Canada, right? I mean, it's anyways, or
less degree. I mean,
I think Canada maybe make a different. Yeah, maybe a little bit. Canada's a little bit different. Obviously, the US is a different story too. I think like households are in much better shape. They probably overstimulated, et cetera, et cetera. But I think it's important to contextualize all of this for everybody that, rates are going up across the world, but none of these economies are one and the same.
Right.
But they're all, now we're sort of in this currency war where everyone's trying to get, basically trying to prevent their economies from blowing up.
I think there is an event or scenario coming up. I think it's a small percentage I would allocate or assign to it. But think about a world where, energy, it doesn't surge, it doesn't collapse, it sort of stays where it is. Other economies, they do experience a lot of stress, but the Canadian economy doesn't. The banking sector is able to manage the housing market and all that. It just creates an environment where the Canadian dollar, it will come down relative to the USD, but relative to say like Euro, Sterling, Aussie, everything else, it can be incredibly strong. So for anyone, anyone listening, and you do have a lot of excess savings and investment out there, and you've always wanted, that house in Italy or, wherever. I'm being serious.
No,
I think,
know. I'm laughing because you're right. I'm sorry.
Yeah, there is a scenario where, you might get that chance to buy something, really cheap coming up. So again, the point is always be global. Think global. That's the way.
Keith is eyeing his villa in Tuscany.
Yeah, that's
here.
right.
Yeah,
Lake Como.
Your existing house isn't big enough.
Yeah, that's right.
I want to get a place. I'm going to be in like Rade and Chianti. Here we go with that.
Yeah, that's it. There we go.
Reve and all that.
The Ice Cap Winery.
Yeah. So guys, football starts this week. So as a free gift to everyone, what I'm going to do. So here we go. Here's my, I like the 49ers guys. Every week, I'm going to give everyone the prediction on what the score of the big game is going to be.
That's a great idea.
I know. And
a San Fran game? Who cares?
Are we able to hold it to you?
No, you can keep all your winnings. You don't have to.
No. I want
back.
beer. Yeah. I don't want money. I want in the form of beer.
Beer, yeah. So for week one prediction, the 49ers are in Chicago for week one. So the score is going to be, I see, 38-3 late in the game. And then with 2 garbage time touchdowns by the Bears. Final score 38-17 Niners.
Okay.
If you're wrong, if you're wrong, you gotta mail a FedEx beer, Molson Canadian, to Rich.
No, you buy me a beer on December 1st at our Loonie Hour live. That's the deal.
One beer?
I'll collect for everyone that
One
you lose.
beer. This guy's
I wanna...
paying for the event if you're wrong.
Maybe I'll FedEx Rich a Budweiser over to London.
Done. I love it.
What a horrible beer.
My mom loves Budweiser. Shame on you.
I'm actually so fun story. This is a wrap up the podcast here. If you gave me $20 and said, Steve, go to the liquor store and buy us a 6-pack, I will buy Budweiser every day of the week. That's my favorite beer.
Well, my mother and you get along then, because my mom's favorite beer too.
Mama
72
Diaz.
years old, going strong, still drinks a couple beers a week. Loves
just
Budweiser.
shotguns a couple beers every night.
So Rich, but my favorite pint is you can get it over in London. I can't get it over here. It's Bass Ale.
Bass Ale. Okay, I'll have one tonight for you, buddy.
Yeah, I like the Bass Ale.
Disgusting. That's a good place to wrap it up. As always, we appreciate your support. We appreciate you staying patient through all our nonsense banter. All we ask is that you pass this podcast along to at least one family or friend member. And of course, give us a review in Apple Podcasts or Spotify. Help us surpass ArriveCan. We are still on the slow journey there. ArriveCan continues to accumulate hundreds of thousands of views by the day. But we certainly appreciate your support, and we'll see you next week.